On. All right, and recording is in progress. Okay. We'll let people start milling in. Good afternoon, everybody. Welcome aboard for our first Foundation Friday webinar series. We'll get started here in about a minute and a half or so. We'll let all of our registrants trickle in first, and then we'll go ahead and get started. All right, here we go. They're starting to come in.
Now, Carl, it's still morning in Hawaii and on the West Coast.
Well, you West
I know
Coasters.
we don't count. Actually,
East Coast
every
is the
once
best
I
coast.
used to send my commentary out. I send it out pretty early in the morning, West Coast time, like 5:30 or quarter to six. And once I had to send it out, I was getting on a plane. I sent it out too early. I sent it out like at quarter 10 to 3 in the morning. And I got
Ooh.
complaints from folks in Hawaii because they were 3 hours behind. So it was hitting their inbox that night instead of in the morning. I don't know. Fun with time zones.
Yeah.
I marvel at the Flat Earth Society, uh, how they how they're able to pull that off.
All
We
right.
do enjoy your blog for sure.
Oh, I
Yeah.
love it, Rob. I
Well,
really do.
good,
And my kids
good.
love
Thank
dad
you.
jokes.
And we all love Myrtle.
Uh,
All right. All right. We've got a good number of people in, so why don't we'll go ahead and get started. All right. I want to welcome everybody to today's Foundation Friday webinar. This is our first of what'll be at least the first three of the year. My name's Carl Holman. I'm the Director of Marketing here at Foundation Mortgage. I'll introduce our speakers in just a few seconds, but today we're going to be covering the outlook for non-QM this year. We're going to take a look at kind of what happened last year and where we think things are going. And we'll get some of those of you who may not be familiar with us. This may be the first time you're hearing of us. We'll tell you a little bit more about us and how you can work with us in the future. Okay, so Foundation Mortgage was started in '98. We're based and headquartered in Miami, Florida. We predominantly were a residential focused shop up until a few years ago when our current CEO, Marc Halpern, joined the company, and we pivoted to do third party broker focused wholesale and non-delegated lending, correspondent lending. Um, so we offer the full suite of non-QM offerings. We'll have a webinar next month that'll cover in more detail exactly what those are. So you can look forward to kind of a teaser on that. We have a pretty good footprint across most of the United States. We've got 38 states that we're in, that you don't need a license to do business purpose only loans. And we're hopefully going to be expanding a little more this year. So I'll cover the agenda real quick and then I'll introduce our speakers. So we're going to cover 6 major areas about setting the stage, where we're at, looking at the trends and forecasts. Like I said, a little bit more about foundation, some of our recommendations and how you can succeed this year, and then just kind of looking ahead. And then we'll take 10 to 15 minutes for Q&A. Couple quick things: the microphones and videos for participants have been muted, so we can get a clean recording. We are recording this, and we will send that out to anybody who's RSVP who did or did not attend within probably 24 hours. It's Friday, so it'll probably be on Monday that you'll get an email with a link to it. We'll also send a copy of the deck if you're interested. And with that, let me introduce our 3 speakers. First, we have Marc Halpern. He is the CEO of Foundation Mortgage, and then somebody who I've had the privilege of working with previously in another life, Sam Bjelac. He is our SVP of National Sales and a recent joinee to the company because he loves us. And then a longstanding friend of pretty much, I think, everyone in this industry, Rob Chrisman. He is going to be our moderator for this afternoon. And he is, of course, the founder of the Chrisman Commentary, which is one of the most widely distributed blogs, podcasts. And he also has a number of other podcasts that he does with himself and his uh, partner, Robbie. So with that, Rob, let me pass the mic to you. I will be off camera for a while and let you guys. I'll be back in about 45 minutes to an hour when we do the Q&A section. Right?
We're going to go off script right off the bat,
All
Carl. Hope you
right,
don't
way to
mind.
go. All right,
Love
good
it.
luck,
I,
gentlemen.
wa- I wanted to ask Mark, starting a company isn't necessarily for the faint-hearted. What were you doing when you decided I'm going to do something a little different and start this?
Well, I've sort of always beat to my own drum, and it was at the end of 22. Who Scott Jones is the former owner of Foundation. It was a retail-facing shop. Scott is still on board with us. He is actually the chief administrative officer, and he sort of had enough. He had two young children. He says, this company is for sale. At the time, over the summer, towards the end of 22, I had done a lot of business at that time with Sprout and certainly Elliott Salzman. At the time, was one of the top non-QM producers in the country. And I had a very strong relationship with Elliott, who obviously has a strong background in running a wholesale non-QM shop. So I basically was able to sort of take different pieces to the puzzle and put it together. And I said, Scott, I'm going to buy a foundation here, and we're going to flip it from a retail to a wholesale shop. And here we are, right? The pieces, it all made sense. It was the timing, like in life, timing is everything. So at that time, I'm like, this opportunity only comes by once in a lifetime. I knew I could take advantage of disruption in the market at the time, and that's exactly what I did. So here we are going into year number 4.
Very good, very good. And Sam, before we get into the meat of the agenda once again, is there anything that the viewers, listeners should know about in terms of current initiatives that Foundation is offering or that you're carrying out?
Well, yeah, actually, thanks for putting that up. So, yeah, we are having a sales special this month for mortgage originators on our non-QM business. There's 3 basis points on all purchase loans, 25 basis points on refinances and second mortgages. Again, these are loan amounts over 500,000. These must be submitted by the end of January and fund by the end of February. So you can contact us after this meeting, or if you're approved, reach out to your account executive and you can get more information on the current pricing special we have.
Okay, cool. Well, I'd like to step back a little bit and people who've been in the business, especially brokers who've been in the business for a while, have seen been through the early 2000s. Things were going well. We had a lot of Alt and subprime and so forth, and that came to an end with the financial crisis. And Dodd-Frank created the CFPB, which created QM and non-QM. And I think for the initial years of the non-QM industry in general, there was a tremendous amount of marketing effort that was going on to tell the industry that non-QM was not subprime. And that was definitely a kind of a waiting game. It took a while, I think, for the industry to come around. 2020 and 2021 didn't really help with the pandemic. There was, loans were falling from the sky. You had Fannie Mae, Freddie Mac, FHA, VA production that was just going gangbusters. And so non-QM, I think, took a little bit of a back seat. But as volumes diminished, obviously 2022, 23, 24, 25, so many lenders and vendors said, you know what, we need to be able to offer all products to consumers. Nobody wanted to lose a borrower. No broker wanted to have a borrower come through the door and have that broker say, well, I can't help you. And so non-QM, non-agency, DSCR loans and so forth, I think have seen a nice resurgence. And you're right, Mark. I mean, timing is everything. And Foundation was right there, kind of riding the wave. And you didn't have the baggage that a lot of companies do. So you've been able to establish this company that is, for lack of a better term, clean, and it has a great reputation out there. And I think that that says a lot about the people that you've hired and a lot about you. So it's nice to see that going on. So in terms of the 2026 landscape in general, I think you know there's demand for this product. Uh, there's a supply by companies like Foundation in order to fund this kind of product, and investor sentiment is something we're going to talk about, I think, during the show. But investors like this product. Obviously, you wouldn't want to manufacture a product that didn't have an outlet on the other end. So we're going to be talking about that. And I wanted to pull Sam in to talk about kind of the borrower and broker trends that you're seeing. I mean, Sam, your fingers on the pulse of it. What are you seeing out there currently?
Yeah, with respect to non-QM, it's really built around filling a void in the market, providing liquidity for self-employed professionals. People that make a lot of money. They take either advantage of the tax laws that are out there, or they have very complicated business structures where they own multiple businesses. That's a big part of it. We still see that today. Very large group of real estate investors have taken advantage of liquidity in non-QM. And also, we saw a pullback, right, by the GSEs, whatever it was, 3 or 4 years ago, when they put some large LLPAs in on their non-owner occupied loans. That kind of opened the world for non-QM to go into the real estate investor market. We see a lot of high net worth individuals, with complex income. So people, again, that they've got a lot of liquidity, they've got a lot of cash flow, they just don't have. We do see some increase in foreign nationals too. It was, several years ago, a lot of people were purchasing property in the United States for investment reasons. If it was someone from South America buying condos in Miami, or people from around the globe, investing in real estate. Actually, so that's some of the main people we see, the main borrowers that we get across the table. And non-QM has really filled a void, of that liquidity.
And Mark, what have you seen as 2024, 2025 have passed by? Now we're, first week into 2026. Any surprises in terms of the broker world out there? Anything have you on your, sitting there at night thinking, I should have seen that coming?
No, that's hindsight, right? So, but no, there's nothing that I see at this point. I mean, we always have, which we have no control over, sort of a black swan event, right? But, albeit outside of that, we see a pretty stable broker market right now. I can tell you that throughout December, traditionally the last 15 days, things slow down. So it certainly slowed down for us. But I can tell you that just this week, production has ramped back up. We had the largest months in October and November as far as submissions were concerned. So we see that starting to trend back up. Certainly, December was an anomaly. And, the broker community, as you alluded to, there are certainly, the competition that was out there, that they want to capture every single loan. So all that we do is provide certainly non-QM loans for our partners.
Yeah, that's all. Yeah, that's a noble thing to do. Uh, in terms of interest rates, I'll put on my capital markets hat here for a few minutes and talk about interest rates, and it's summed up here on the slide, talking about stabilized but elevated. I think that you know anybody hoping for a 3% 30-year fixed rate mortgage is going to wait a long time, if not forever. I know that we had some news yesterday about Fannie Mae and Freddie Mac stepping in and buying, which I assume agency mortgage-backed securities, not non-agency mortgage-backed securities, and that helped the agency market to some extent. But we've we've kind of seen this before where uh, the Federal Reserve came in 2020 and 2021 and used capital to buy treasuries and mortgage-backed securities and really push prices up and rates down. But, that ended and we went through 2022, 23, 24, 25 in an elevated rate environment compared to 2020 and 2021. Now, it's not elevated when you talk to somebody who's been in the business for a long time. You hear these stories about, oh, I remember when rates were, 18% or whatever it might be. So it's elevated in terms of where rates were 4, 5, 6 years ago, but it's not too elevated on a historical perspective. So you have lenders and originators and brokers saying, all right, rates are what they are. They're higher than they were 5 or 6 years ago, but that was 5 or 6 years ago. Let's take the products that we have now. Let's take our reputation. Let's take our service levels. Let's take our technology, given rates where they are, and let's focus on, helping brokers, in this case, Foundation, helping brokers help their clients. And I think the realization of that is pretty pervasive in the industry. So, the common saying is hope is not a strategy. And I tend to agree with that. Anybody hoping to really help their career, oh, I need 3% 30-year fixed rates to really help my career. Yeah, it's going to help, but what's that going to do? What does it say about the economy to put us back down there? You have, on the slide here, we've got, inflation, which is obviously a factor. Employment, we had some numbers this morning talking about unemployment. And in general, it's believed that the employment market was relatively weak. Inflation appears to be under control. A lot of the tariffs uh, that were put on, they were taken off or revised. Some are still on. So there was a little bit of tariff volatility. But overall, the tariffs have not impacted the inflation rate as much as some experts thought would happen. So that's a good thing, obviously. And then housing supply, housing supply was a big factor uh, about a year or two ago. The builders haven't kept pace with the demographic population increase and so on. But in the last, I don't know, 6 months or a year, it seems like inventory levels have picked up and affordability has replaced inventory as a concern. So the environment right now, the macro environment snapshot, I think, it's a pretty good place. I mean, we could easily be in the same situation throughout much of 2025. So as I said, once again, it comes back to what are companies doing to capitalize on things and help their borrowers. So, Sam or Mark, anything you'd like to add to that?
I think the only thing I'll add is, in past years, I would say we're cautiously optimistic, and speaking with your son Robbie recently, I think we coined the term cautiously cautious. So I think that's what I'm going to use this year as far as the market. So you know, I think that will do.
Yeah. All right. So let's talk about investor sentiment. Mark, I'm going to turn this over to you to some extent because you and your staff are dealing with investor sentiment. Have you seen it shift at all? What's the health of the investor like that's out there?
So the health of, we have obviously two buckets. One is going to be life insurance companies, and the other is going to be the securitization market. Um, so the securitization market, in 2025, I believe had record numbers. You still see many different there's more money out there than product pretty much for DSCR. DSCR is certainly a favorite. Bank statement, those are the two main products. So there's a very healthy appetite for the product. It's performing. You have low LTVs when you average this out. You have high credit scores. You are seeing a tick up depending on the vintage, going back 22, 23, 24, as far as performance in some of these asset categories. But for the most part, investors, they're basically crawling over each other trying to get the product.
Yeah, I would tend to agree with that. From what I'm hearing uh, and seeing, DSCR mortgage rates, non-QM mortgage rates, they've come down relative to agency mortgage rates for those very reasons.
Yeah.
The investor appetite is there.
And they're performing.
And the performance. These loans have to meet the ability to repay, and the investors over time have learned that, and they are looking for yield pickup. So if you can buy a pool of loans, uh, Fannie Mae or Freddie Mac loans or FHA VA loans, and earn, I'm just going to throw numbers out there, earn 5.5% or 6%, and you can invest your money into a pool of non-QM loans and earn, 6 or 6.5 or 7. And those loans, like I said, have to meet the ability to repay, and the properties are appraised correctly, and everything's done in a compliant manner. You want that pickup.
Yeah.
So,
And
the demand has been good.
along with that pickup too, you get a much lower LTV, so there's more equity for the investor, and typically a better credit profile too.
Yeah, and one other pickup, from the investor standpoint is if you're looking to go buy, call it investment QM product versus non-QM, non-QM is going to have a prepay associated with it, right? So you have less runoff risk on your book.
Right. Sam, if what in terms of the capital markets, the secondary market, anything else that you can think of that brokers should know about what happens to the loans after they're funded by foundation?
Yeah, I mean, once the loans are funded, we do our work on the back end to make sure we have all of our ducks in a row. We've crossed every T, dotted every I, and that we can make a sellable loan. And then we sell those loans off typically to I don't say the highest bidder, but let's say the bidder we know that we can do business with on a consistent basis. We have several outlets for the loans, multiple outlets, and we typically work with loan sales a couple times a month to keep liquidity, and just kind of move forward, like that.
Yeah. All right. Good. Yeah, it's not quite the black box that people think it is. Uh, you manufacture a loan and you sell the loan, and there's a market for that loan. And if there's no market for the loan, you wouldn't manufacture the loan.
Right.
And I think that from what I hear from investors out there, when you ask them about foundation, as I said earlier, you have a good reputation in terms of delivering a quality product. And I think that that's something that brokers should be aware of, and the brokers should appreciate, right? Um, so on to borrower and broker trends. Um, Mark, I'm going to turn this back to you in terms of your thoughts. Uh, why has Foundation done as well as it has? Why have brokers done as well as they have in terms of the non-QM product? And what kind of product do you see coming through your doors?
I feel really the reason for our success is really um, the people of the company. And I said this on a company call, it takes every single one of us to manufacture a loan, to get a loan in and out the door each and every day and consistently, because people care, right? If there's something is happening on a file and there is an issue and it gets escalated to me directly, I'm going to put it to the president, or if they reach out to the president, like we have a flat company. So if there is an issue, we're going to get on it. And our closing department is second to none. When it hits the closing department, like you don't have to worry, not one bit. And if there is an issue on a loan and it gets escalated, we're going to look into it. If an exception needs to be made or can be made, we're going to make that exception, as long as it fits into a box and you have enough compensating factors that make sense. We want to close common sense loans. Does it make sense? Is the borrower going to be able to repay this loan? What we are also very focused on too is that, for, as you had said, there's good feedback in the community, because of the type of loans that we sell. Because we just don't want to close a loan, get it sold. We want it to perform. That's bigger picture. And that's why we're able to do a lot of things with the investors that we have and we sell loans to, is because of our process.
There you go. That being said, Sam, anything to add in terms of trends that you're seeing out there with borrowers?
With the borrowers, just kind of the same that I mentioned earlier. I think trends with maybe on the broker side, we're seeing more people trying to learn about non-QM. I mean, we work in it every day. We kind of assume that everybody knows what it is. I stepped in the non-QM space in 2017, coming from more of a government background. So I've seen it. It's almost 9 years now how it's matured, and I'm still fascinated when I go to conferences or events like this where I'll ask people who's funded a non-QM loan. Talking to loan officers, and you still get 30 to 40% have funded, and still over half haven't. Right. So I think a good trend for 2026, and we might hit it later in the meeting, is more on creating education and awareness at your mortgage broker company, with your loan officers and with your borrowers, as well as with your referral sources. So I think we might have that on later in the meeting, but just education and awareness.
Okay.
Yeah.
Yeah, I think that's very important. I know that Carl is striving to get that number up. Um, so looking ahead, and I'm not a huge fan of predictions, but uh, oh, no, yeah, let's I mean, I'm not a fan, but we should talk about in general what you guys see in terms of the brokers and borrowers for 2026. And brokers obviously care about growth. They care about what the investors are saying or doing. They care about kind of who's doing what, who's who in the zoo in terms of non-QM products, because there are alternatives to foundation. And I think it's important for brokers to know that. I mean, they already do know that, but what makes foundation what it is, and how it can best help brokers. And then talk about some of the technology and potential innovations that foundation has planned for 2026. So let's get into that. Uh, so growth wise, uh, Mark, what are you seeing out there in terms of initiatives that Foundation has for this upcoming year?
So as far as, let's just speak about certainly the loan products. We have enabled certainly AI, where a broker can work on his own and not necessarily have to submit his bank statements to us. So we've enabled that type of technology, get a quicker calculation of income, to be able to better facilitate and move the process along rather quickly. So we're taking steps, not just with that, but throughout our process, our disclosure process from open to close. We are investing money in technology, certainly, around AI. We have an internal for our purposes, in our guidelines. And so the account reps, certainly, that people can reach out to, have answers on their fingertips, whereas in previous times, it took, hours, days, or weeks to get that correct answer, because it had to get escalated to even to possibly the secondary market. So with that being said, moving on to certainly DSCR, there's a thirst for that type of product. Um, what you're seeing, certainly 1099 programs, that's performing. P&L programs, the secondary market, you're starting to see some cracks in that, quote unquote, no pun intended, foundation. Um, you're also, what you're seeing, from the traditional, the old school traditional jumbo loan program to jumbo non-QM. Non-QM, our rates are even more competitive, because the investors see that these loans perform, because they are going to be full docked, or they're going to be asset backed. So there's a lot of products that are out there. Certainly our developer, our director of marketing, Carl Holman, has developed white labeled marketing materials to help the brokers. We want to help grow the brokers. We want to be the support system for the brokers to build their business.
That makes a lot of sense. Uh, Sam, in terms of what brokers should know about, well, we kind of, yeah, moved on to the next slide, Carl. That's fine. I want to ask Sam, what should brokers be aware of in terms of, you know, rate, price, and so on, service, in terms of, uh, you know, where the product is being delivered, that the brokers, process, foundation funds, packages, sells. What should brokers be aware of, do you think, coming up this year in terms of the investor outlook?
Well, I think we hit on a lot of it too. I mean, in the investor outlook is strong. We're seeing regular issuance of non-agency RMBS, especially for the senior tranches. Right, the investors love the debt service pools Mark mentioned with the call protection, lower LTV. Even when these loans are delinquent, if a certain portion of them are, the real losses are minimal, right? They're basis points because of what the average LTV ballpark. Let's say it's 70 LTV on these loans. So I think you're going to see better capital market execution later in the year. Pricing now is more transparent than it ever was. The only thing that might be to drag on it, or you get some headwinds. You have some higher warehouse costs. Hedging expenses are a little bit more, and there's increased competition too. So that's kind of I think the main pieces of it.
Yeah, I would agree with all that. The hedging has always been a problem uh, for for as long as I can remember, 40 plus years of whether it's ARM loans or way back when subprime loans or non-QM, DSCR, non-agency loans, the hedging of that production is is not something that many lenders want to do. And so it's better left to say foundation to be able to hedge that pipeline because you know what you're doing in terms of the secondary market. And I think that efficiency gets passed on to brokers and their clients because you do know what you're doing. So, yeah, I would agree with that. Uh, Next slide, Carl, if you would please. I wanted to return to Mark in terms of market share and kind of, like I said earlier, who's who in the zoo and who's doing what. Uh, in terms of the overall channel, the overall piece of the pie that is non-QM and non-agency loans, where do you see that going this year?
I only, see the that share of the market continuing to increase. Sam alluded to, if you ask people, many originators, they're still stuck on, government and conventional. Like this is still, listen, the market's tighter. There's less deals that are out there. You need, as an originator, you need to have the different tools, right? And you need, different investors or different, you know, mortgage bankers in your pocket, right? We're going to do stuff, we find a lot of times that we get transferred appraisals from many other lenders. And it's in our guidelines. Our guidelines fit the scenario that they couldn't get done at one of our competitors. So I just, with our education platform and what we're doing here today is educating our broker partners on, hey, how can you capture that one extra deal per month? So that's where I see that originators can help themselves to go increase their volume by getting a look at what we're doing different, how we look at a file. As I alluded to many times, our guidelines, are pretty broad. And if there needs to be an exception made to policy, we're okay taking a look at that and granting that exception because it makes sense.
Yeah. Sam, you mentioned earlier your government background. What exactly were you doing before I ask you this next question?
No, federal government working in government loans, I guess would be
Right.
yeah. Mainly working with Ginnie Mae, fulfilling Ginnie Mae loans on using manual underwrites. Typically for lower FICOs was my expertise. and it's similar here, not the credit scores, but where the compensating factors make a big difference. The government the handbook has a big set of compensating factors, and here in non-QM, that's a big part of it too. When you're looking for an exception on a loan that doesn't meet guidelines, we have several different lists of compensating factors that we'll accept, and that's kind of common sense underwriting too. So that's the background there, if that makes sense.
So we're going to go off script yet again here, Sam. I'm going to ask you something that I was asked yesterday, and I kind of fumbled my way through it, and I've been thinking
Right.
about it ever since. And somebody asked me, "Hey, uh, do you see credit quality going down in 2026 as an industry?" Are we as an industry, do you think, looking or will we be more accepting of lower credit score borrowers? And I want to remind the brokers on the phone here on this call that one, non-QM, non-age is not subprime. And it's not, I mean, I hear some amazing stories about borrowers that go through non-QM channels for various reasons, whether it's bank statements or whether the property is, some on some condo association, whatever it might be. There are top-notch borrowers who are going through the non-QM channels. But Sam, do you think that uh, the credit, how do you see the credit trends moving, if at all, this upcoming year?
Yeah, and I'll take off the non-QM hat for this, and I'll talk more macro, just what I think. So we spoke about the government loans earlier. There's large pools of loans out there that contain high DTIs, right? Let's go back 2 years. People were underwriting to a 55 DTI. What have we seen happen over the last 12 to 24 months? We've seen property taxes rise. We've seen property insurance go up. We've seen association fees go up. So those government loans with the 50 or 55 back end are probably a 60 to 65 back end, right? So there's a big squeeze there. So that can't be good for that type of borrower. And then I think just general overall credit utilization, right? We've got, the number better than me, Rob. Is it $1 trillion of credit card debt out there, or whatever it is? The highest it's ever
1.1,
been?
I think.
Yeah. How's that get paid off? I don't know. So I think just looking at it from a macro level, you've got loans that were underwritten at high DTIs with very little um, um, wiggle room, right, in it, and then you've got this looming credit card debt and consumer debt that's out there, and that doesn't include the pay now buy later Klarnas and all that. None of that even reports on credit. So not being a doomsday guy here, but I think for a certain percentage of the market, there's going to be some tough days ahead.
Yeah, I remember the increase in Alt A and B and C paper, and people would say, well, borrowers need to borrow money. It's just a matter of figuring out the rate and price. I tend to agree with what you think about credit. Uh, it's a moving picture. You've got the FICO out there, and you've got Vantage Score, and you've got credit costs going up and so forth. And meanwhile, you've got the borrowers who are dealing with student loans or credit card debt or whatever it might be. It's always a changing landscape, and you want to help the people that need help and want to buy a home. And it's just a matter of doing that. And I think Foundation has some good programs that brokers should know about in terms of tailoring the parts of that loan to certain borrowers. And obviously that's one of the skills that brokers have that I would, I'm not a huge fan of AI and technology in that sense. And I'm sure it's being used within Foundation, but I always want to talk to a person when I call American Airlines. And I think that AI, though, used as a tool, can very much help brokers and help AEs help brokers. And so that leads into this next slide. Mark, I mean, Foundation has established itself with a reputation of being able to help brokers with technology and automation. What's going on now? How has the company changed with regard to automation and technology? And what do you see happening in 2026 to help brokers?
Um, so we have certainly evolved, as we started, certainly on a shoestring budget, that those budgets have increased year over year. Um, And our focus here for 2026 is really the technology and the automation, right? So, to add on to our AI, to use AI to our advantage. While I see that QM loans, at some point, it's going to be a completely automated, like you're going to buy a car, right? You can have everything plug in API into and make an automatic decision. Certainly, Fannie Mae has the data as far as value is concerned. You can go out to the IRS, and so that's going to get, I feel, is just on the QM side is going to get completely automated. Well, we're working on some programs. I feel we're going to automate the process as much as possible. But for brokers really need to focus on non-QM because there will always be a need for the broker for that human approach to be able to tell that story, right? And so that goes back really to the exceptions, right? Okay, give me the story. And that has traditionally in my retail career. I remember in 1993 when I got in the business, I remember, Jim Vreeland, I'd bring him a deal, from someone in Miami. He's like, Mark, where do you find these people, right? So that has always been, my prize is being able to figure it out. So there will always be a need. Yes, we're going to use automation, but you're going to need the human approach. There's always going to be a need for that QM, non-QM borrower to have a broker involved in the transaction.
Right. I agree. I remember when DU and LP were rolled out and
Yeah,
everybody, all the experts were saying, well, that's the end of underwriters.
yeah,
And how'd that work out?
correct. Correct.
Underwriters were the hottest commodity in 2020 and 2021, trying to find a good underwriter to underwrite these loans. So the Mark, I'm going to return to you. I mean, actually, you know what? I'm going to ask Sam something before I turn to Mark on this one, on this slide. Sam, you recently joined Foundation. Why?
Well, I think it's a couple things. I think the main reason is I know these guys, right? We've worked together before. Mark was actually a client of mine for years. He was one of my top brokers. And then the people we have in the back office, we have a lot of history together. We've worked together and a lot of good chemistry. So although I just joined the team, I feel like I've been on the team the whole time that Foundation's been around. So I think that's the big reason I would say. And then in knowing the people that are here, right, the people that are working here, I know that they can get deals done. So I know our credit philosophy. Mark had mentioned Elliot Saltzman. Elliot was integral in the growth of my non-QM career as far as getting loans done for brokers, being able to come back with a quick no or yes, right, not dragging things out. So I think the team that we have here really, really is a team. I know it might sound like that, but it might sound a little weird, but it is. I mean, we hit the ground running. We just had some corporate meetings in California in December. It was very good, very enlightening. We were able to, as a small group that we are, and we're less than 100 employees, but it feels like a much bigger company. So if that answers your question.
Yeah, no, it does. And Mark, I wanted to let's use a sports analogy, if we could, real quick here in terms of talking about goals and objectives and what kind of foundation has. But it's easy for a football team to say, okay, we're going to march down the field and we're going to score a touchdown, and we need that winning philosophy. So we're going to win this game, and as you know, half the teams win and half the teams lose. Not everybody is able to carry out what they're trying to achieve. How have you been able to carry out Foundation's philosophy in terms of helping brokers out there? What should brokers know about your philosophy and how it can help them help their clients?
Well, it's well, first of all, what's the spread on that? What's the right? So at any rate, I think that our main philosophy is like the get it done, all hands on deck philosophy, right? So, there's we if we have the loans, we have the volume, we're going to put the money into overtime, right? So we're going to get these loans moved through the process. We're going to help our brokers because I have I have the experience. I know what that broker's going through, right? As opposed to on the wholesale side, right? They're not borrower facing, right? So I know, and I can understand the position that they're in. They got three realtors calling them. You got the husband and wife, and then you got the seller calling because it was supposed to close the days before, right? Well, they forgot to get the W-2s that we've been asking for, for 4 months now. I'm being facetious, obviously, but you know what I'm
No,
saying?
you're not. No, you're not. I'm sure you've seen that happen.
Of course. Why can't we close? But I know I've had that experience. I've been in that position. I've made those phone calls, right? So I think that you have a team, especially me leading the team and knowing the position, that again, that the loan officers feel. And at the end of the day, I do continue to remind everyone here behind a loan number and a name of a loan, there is an actual borrower and we're affecting their lives. Whether it's on a purchase and they have a U-Haul sitting out in front of the title company to go close on that loan, or they're doing a cash out refinance because they need those funds to invest cash flow into their business. So I'm well aware of exactly what the broker is going through, and I go ahead and impart that upon our workforce.
Uh, Somebody sent me a text who's tuned in here. Did not put did not put the question in the chat. I'm going to throw this out to both of you guys. How many non-QM investors should a broker do business with?
One foundation, right?
There you go. All right.
Well, listen, again, as a broker, having that experience and you'll sign up with 10 different lenders, but it's those lenders that you end up having that relationship with that you can make the phone call to the Marc Halperns, when it needs to get escalated, or an escalation or a SAM, right? And that's what certainly sets us apart from some of the larger entities that are ultimately owned by a private equity company. And those people that are working within that company can't make their own exception decision. 99% of the exceptions are made in-house. It's up to us. We close our loans. There are no secondary loan approvals that we need to wait on. We fund off our warehouse lines of credit. It's our decision. We're not taking your loan and sending it out. We are not acting as a non-delegated. It's all delegated. It's our underwriters.
Yeah. And I'll throw this out to both of you guys. What do you look for in terms of, or what is your ideal employee in terms of who you would hire? What do you ever hire brokers? Do you hire new people out of college? Do you want to hire somebody who's been working as an account executive, for example, at another shop and something's changed and they're looking at foundation thinking, I like their philosophy. What does your ideal candidate look like when you bring somebody on board?
I'll speak to the sales side at least. People that have done not. And this is just in my experience in non QM is account executives that have worked in non QM before will hit the ground running and have a great chance to be successful. So we do look for that. I've noticed through the years people that come from the A-paper GSE type of account executive backgrounds, or maybe things were more automated and maybe they answered the phone and they didn't dial the phone, they tend to be less successful in the non-agency space. So I think that's a big part of it, and people that want to roll their sleeves up and work. I mean, this isn't. I said this before. This isn't push button get mortgage, right? Non-QM, you got to roll up your sleeves a little bit. You got to dig in. You got to structure the deal. Sometimes you got to restructure the deal. So someone that's maybe a puzzle solver, right? Someone who likes to figure out how things work. I know when I first got in the business, that was the kind of the bell that went off in my head 23 years ago now. I'm looking at 2026, 23 years ago. Was once I structured that first deal, I was like, "What? This is for me, right?" I just like solving that puzzle. But Mark, you want to add anything to that?
I mean, that I've always been a problem solver, right? So
Yeah.
that's why I've excelled really within the space. I did much better on an essay than a multiple choice test because, they all made sense to me, right? So I think that's the right spot for that type of person, a thinker. You want someone that's going to think of different ways to get to get certainly get a loan done. And it's also, Rob, not to say that we haven't looked at certainly one-offs of people that, were even in the title business, or, or was an originator and they want to if the story makes sense, right? We're going to take a look at them. We have hired those people in the past. It's a small percentage, but you will take a look at anyone. Again, what's your story?
Yep. Yep. Exactly. All right. I know that we have only a little bit of, well, we've got about 10 minutes. And I was going to ask Carl if he wanted to join us again here, talking about some of the things that Carl and you, Sam, and Mark have in terms of bringing the brokers up to speed in terms of training and the enhancements and so forth. So, uh, Carl, do you want to take some of
Yeah,
this?
yeah, we'll take that real quick. I can't remember if Mark or Sam had mentioned it earlier that we do have, white label flyers that we can provide to the brokers that'll help them obviously market our products to borrowers. Again, for me, a big push is broker education. As Sam mentioned, 30-40% of the people he talks to don't have a clue what non-QM is. So we do that by educating people through webinars like this. We publish a blog every 2 weeks where we try to introduce, you know, tools and tips and tricks and ways that people can work with non-QM loans, either specific types or broadly. Joining our social media platforms, we're investing a lot in that in terms of video and other materials. So we're always trying to find a way in our social media to not just push product, which I see a lot of lenders do. We try to say, here's what you can do with that product, and here's how you can help these types of borrowers think about using this type of loan instead of going government or agency. Uh, so that's kind of where I'm at, as well as using, like Mark mentioned, using AI to just make us more efficient. I've been in marketing teams of 6 people, 40 people, um, but with AI, it's I can do it with a lot fewer people now, and a couple of designers. So it's for us, it's about being lean, efficient, and smart with our money, so that we can, do the right thing for the borrower and the brokers. So
Yeah,
that's my
it's
take.
the a good analogy that I've heard is that it's like, oh, I'm going to build a house and giving, a hammer and a saw and some nails to somebody and some wood. Well, that's not, I mean, those are kind of the basics, but you need training. You need to train that person how to use those tools. And I think that Carl, in your career, you've done a very good job of training people how to use the basic tools, and it's paid off. So, congratulations on that.
Thank you. Can't do it without these two gentlemen either.
All right. So, what's next on the slide deck? What's coming? Ah, that's a good question. What can brokers look forward to? Mark or Sam? What do you got? What do you got up your sleeve?
Well, I think one thing that we've been working on and we developed, and it's been all internal, and it will come external at some point in the year, is an easy way for brokers to find what product fits what loan program. Right? We have the basic pricing tools now, but it'll be more dynamic. It'll be more instant where you can figure out what guideline it meets. If it doesn't meet the guideline, what are the compensating factors that it might need to meet that guideline? So I think that's going to be pretty exciting. We're going to have a much more robust broker training modules out there this year, not only just for our new brokers when we onboard them, but for existing brokers that want to learn more about it. We can set up, obviously, webinars for new branches or hires, custom trainings for those broker partners for their loan officers. It kind of takes some of the pressure and some of the resources spend away from the brokers. We'll take that on and we'll train your people. So I think those are the two big ones. But also we're going to be more out there in the marketplace. We're going to be at a lot of different events and conferences. Mark and I will have the opportunity to speak at these live events. I encourage I encourage loan officers, if there's something in your area, take some time out to learn. Not, I mean, we'll be obviously presenting on non-QM, but there'll be a lot of other information out there. Support your local state and regional associations. They're the ones that are out there providing this for you. So just kind of look for us. We'll have our calendar on our website. You can reach out to us. We'll tell you where we're going to be. Follow us on social media, and just keep up with it.
Good, 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 good. Mark, anything else that the broker clients can look forward to?
Yeah, I think what we're very as cautiously cautious, optimistic to, for a great year in 2026. It's the way that we see it today. We're ready to rock and roll. We're ready to certainly onboard new brokers, assist our current brokers to help build their business.
Yep, yep. Well, Carl, do you want to take it from here?
Yeah, I mean, I haven't seen anybody throw any questions into the Q&A panel, so
Just that one
uh,
text I got from somebody
yeah,
who's
I'll
watching.
I'll kind of wrap us up here and give people a couple minutes to join us if you want to throw your questions together as we've talked about it. Like I said, we'll send this recording out as well as the deck. So there's some areas we haven't had a opportunity to cover, but we will be doing 2 more webinars that we've already lined up for the next couple of months. So next month, the first Friday of February, we're going to look at non-QM opportunities in today's market. So that's basically going to be a very high level overview of all the different loan products that we offer, um, with sort of in-depth analysis of all of our underwriting requirements. So for people who are interested, if you haven't reached out to your account executive to talk to them, that'll be a good opportunity. Sam will probably be one of our speakers for sure, and we're going to line up somebody else that we're still negotiating with. And then the first Friday of March, we're going to be doing a spring housing forecast. Uh, People joining us will be Rick Sharga, who worked with Sam and I at another institution, but is also one of the most widely regarded people when it comes to the housing market. And then Selma Heap, she is the chief economist at Cotality. She oversees which used to be known as CoreLogic, but she oversees the whole mortgage and housing section. So she's going to also be a good resource for data. So it'll be a little data heavy for data nerds that are out there. But I've done multiple of these sort of predictive forecast webinars with Rick, and I have yet to see him be wrong. So I think it's for people that really want to get a leg up on other people. This is going to be a good combination. So I'd encourage people to sign up for those, and we'll send out in the follow-up email. There'll be registration links for those people that want to do that.
Good.
Otherwise,
Got a lot going on.
yeah. So, and in terms of other webinars, there'll be a brief survey when you go to log out. A couple quick questions. Let us know. This is our first one. How did we do? What'd you think about it? There's an open ended question. So if there are topics that you would like to see us tackle, either as webinar, blog article, go ahead and give us your input. We absolutely want broker feedback. It's critical, I think, to any smart lender to listen to what their brokers want. Um, so that's kind of my extra 2 cents. As Sam mentioned, go to our website, join all of our social media. Mm, I'm a little hurt that he didn't remember to remind people about Scotsman's Guide, but we also are on the cover of this month's Scotsman's Guide, so there's some good information in there as well about us.
Good.
So I think I've done all of my commercial stuff. Um, so and again, I don't see. Oh, we do have a couple questions. Is anyone going to the non-QM event in Miami Beach next week? Yes, yeah, at the Miami Winter Mortgage Expo. Sam will be there. Two of our other representatives will be there. Um, so we definitely have that. And we'll also be at the New England Mortgage Expo if there's anybody else sort of in the New England area. Um, how about a section on non-QM verification letters? My completely unbiased opinion, of course. Not sure who that person is or what they're getting at. Anybody know what they're alluding to there?
We could take a look at it after and get back to.
Okay. All right. Well, those are the only questions we've gotten. So if that's going to be the case, we will end promptly at 3 o'clock. And like I said, if you guys can take a couple minutes and do the survey, appreciate Mark and Sam for their great observations and their time today. And Rob, as always, it's good to see you. I like having you as our moderator.
Thank you.
Thank you,
So
Good to
Rob.
be here.
all right, great job, gentlemen, for our first Friday. So we will see everybody back here hopefully on the first Friday of February for our next one.
Yep.
So
Take care.
everybody
Thanks,
have
guys.
a great,
Appreciate it.
wonderful
Thanks,
evening.
everyone, for joining.
All right,
Thank you.
guys. Be well.